You have been lied to. Your entire life, society has hammered the same mantra into your head. Go to school, get a job, get married, and the Holy Grail, buy a house. We were told that renting is like burning money in a fireplace. We were told that renters are losers paying someone else's mortgage, while homeowners are geniuses building equity. But let's look at reality. It is the year 2026. The world has changed. The rules of the game have changed. And if you are blindly following the advice your parents gave you in the 90s, you are risking making the single biggest financial mistake of your life. A mistake that could cost you hundreds of thousands of dollars and trap you in decades of financial stagnation. What if I told you that renting, not buying, could be the key to making you a millionaire? What if I proved to you with cold, hard math that owning a home is often a liability masquerading as an asset? Most people turn off their logic when they see the keys to their dream home. But we are not here for emotions. We are here for the math. Watch this video until the very end, and I will show you a calculation that will make you want to cancel your meeting with your realtor and thank your landlord. Let's get into it. First, let's understand the context. Why are we talking about this right now, in 2026? Because the economic landscape has become brutal. We survived the inflation spikes. We watched the Federal Reserve play ping-pong with interest rates. Yes, rates have stabilized, but the days of free money, when you could get a mortgage for 2 or 3%, are gone. They are history, and we might not see them again in our lifetime. Meanwhile, home prices in the U.S. have not crashed. They are stuck at all-time highs. This has created a trap. On one side, expensive debt. On the other, overpriced square footage. People buying homes today are often spending 40 or even 50% of their net income on housing. This is financial suicide. You become house poor. You own the walls, but you don't own your life. You have no money for travel, no money for quality food, and zero money for investing. You are working just to feed the concrete. Why is the myth that renting is throwing money away so persistent? Because people confuse consumption with investment. When you rent, you are paying for a service, a roof over your head. It is like a subscription to Netflix or leasing a car. You use it while you pay. When you buy a house with a mortgage, you think every payment is going into a piggy bank. You think you are paying yourself. This is the greatest illusion of the middle class. Here is the mechanics that the bank won't tell you. When you take out a 30-year mortgage, for the first 10 years, the lion's share of your payment is not principal. It is interest. You are not paying yourself. You are paying the bank for the privilege of renting their money. That is also thrown away money. But instead of going to a landlord, it goes to a banker in a nice suit. Here is a simple truth you need to tattoo on your brain. Your rent payment is the maximum you will pay for housing in a month. Your mortgage payment is the minimum you will pay. Do you feel the difference? When you are a renter and a pipe bursts, that is the landlord's problem. When the AC unit dies, that is the landlord's problem. When property taxes hike by 20%, that is the landlord's problem. But when you are the owner? Welcome to the real world. Property taxes, insurance, which has skyrocketed in 2026 due to climate risks, maintenance, a new roof, lawn care, fees. These are unrecoverable costs, money that leaves your pocket and never comes back. Economists call these phantom costs, and they often equal or even exceed the cost of renting a similar place. Now, let's get to the meat of it. Let's talk about opportunity cost. This concept separates the wealthy from the poor. Poor people think about how much a thing costs. Wealthy people think about how much money they lose by freezing their capital in that thing. Imagine a scenario. You want to buy a house for $500,000. To avoid private mortgage insurance, or PMI, you need a down payment. Usually that is 20%. That is $100,000. You take that $100,000 out of your pocket and give it to the seller. Poof! It is gone. It has turned into bricks. What happens next? That $100,000 stops working for you. It is trapped in the drywall. Yes, real estate appreciates. Historically, it grows at about the rate of inflation or slightly higher, let's say 3 or 4% a year. But it is not liquid. You cannot go to the grocery store and buy bread with a piece of your living room. Now, look at the alternative scenario. You continue to rent, and you take that $100,000 and invest it in the stock market. For example, in the S&P 500 index. Historically, the U.S. market returns about 10% per year on average over the long run, even if we are conservative and use 8%. Let's do the math. This is where the numbers destroy the feelings. If you invest $100,000 today at 8% annual return with compound interest and you never add another penny to it, in 10 years, that sum becomes $215,892. In 20 years, it is $466,000. And in 30 years, right when your neighbor finally pays off his mortgage, your $100,000 has turned into $1,062,000. $1 million. Just because you didn't bury your money in the foundation, but put it to work in the best companies in the world. That is the cost of opportunity. When you buy a house, you are saying no to that potential million. You are buying comfort, stability, the right to paint the walls, but you are paying for it with your future wealth. But you will say to me, wait, but rent goes up and a mortgage is fixed. That is true. Rent will rise with inflation. But there is a nuance. Your investments, if you do this right, grow faster than inflation. Furthermore, the dividends you receive from stocks also grow. Let me give you a specific strategy to protect yourself from rising rent without buying a house. This is the strategy for the smart ones. If you are afraid the housing market will boom and rent will get expensive, buy real estate, but not physical real estate. Buy REITs. That stands for Real Estate Investment Trusts. For example, ticker O is Realty Income. The company owns thousands of commercial properties and pays dividends every single month. Or look at the ETF with the ticker VNQ from Vanguard. That is the broad U.S. real estate market in a single stock. If real estate gets expensive, the shares of these funds go up, and your dividends go up. You use those dividends to cover the difference in rent increases. You are hedging your risk while staying mobile. You don't need to fix the roof. You don't need to sue your neighbors. You just get cash deposited into your brokerage account. Another critical aspect is mobility. In 2026, careers are dynamic. The best job offers might be in another state or even another country. If you own a house, moving is hell. Selling a home takes months. You pay commissions to agents, usually 6% of the sale price. 6%. On a $500,000 house, that is $30,000 you just hand over to get rid of the asset. A renter? A renter simply breaks the lease, packs their bags, and is working at a new job with double the salary a week later. Flexibility is an asset. In the modern world, the person who can move fast wins. Of course, I have to be honest with you. I promised to talk about risks. The strategy of rent and invest the difference works only under one condition: ironclad, boring discipline. What is the main problem with renters? They don't invest the difference. They see that rent is $2,000 and a mortgage would be $3,000. They have a free $1,000. And what do? They spend it on a new car, on restaurants, on clothes. If you eat the difference, you lose. In that case, a mortgage is better because it is forced savings. The bank forces you to build equity by paying down the loan. But you are not the average viewer. You are watching this channel, which means you want more. If you have the discipline to take that $1,000 and automatically, on the first of every month, transfer it to your brokerage account, you will outperform the homeowner. The math is on your side. Another risk is psychological. A landlord can ask you to leave. That is stress. That is unpleasant. But let's calculate the price of that stress. Is the risk of moving once every few years worth having an extra $1 million in your account in 30 years? To me, the answer is obvious. Security is not walls that belong to the bank. Security is liquid capital that you can access with 2 clicks on your phone. True financial freedom is when your assets pay for your lifestyle. Imagine this. Your portfolio of dividend stocks and index funds generates $3,000 a month for you. That covers your rent. You live in a beautiful house, but you owe nothing to anyone. You are free. If the neighborhood goes bad, you move. If you want to live by the ocean, you move. So, what is the action plan for 2026? Number 1. Do not bow to social pressure. Buying a house is not a sign of adulthood. It is a financial transaction, and often a bad one. Number 2. Sit down and do the math. Use the 5% rule. Multiply the value of the house you want by 5% and divide by 12. If the monthly rent for a similar place is less than that number, renting is mathematically superior. Number 3. Create a freedom fund. Take the difference between what you would have spent on owning, mortgage, taxes, repairs, and your rent, and invest it aggressively. Buy the broad market or quality dividend growth companies. Wealth is not about how much property you have. Wealth is about how much freedom you have. A house ties you to the ground. Capital gives you wings. If you want to understand exactly where to invest that difference so it doesn't burn up from inflation but brings steady income, subscribe to the channel. In the next videos, we will break down the Forever Renter portfolio that allows you to live anywhere and never worry about prices. Think with your own head, count your own money, and don't let emotions drive your wallet. I'll see you in the next one.